Hello, I'm Todd Rosenbluth, Head of ETF and Mutual Fund Research at CFRA. We're excited for you to learn more about our mutual fund rating system, specifically how what's inside a mutual fund matters. Before we go deeper into our mutual fund rating methodology, I want you to understand how our rating system for mutual funds fits into the broader framework that CFRA offers. As you can see here, we offer market commentary and individual company research, and those two views help to form the framework for our mutual fund research. We have a team of analysts that are covering over 1,500 companies qualitatively on a global basis, and we quantitatively have assessments of over 25,000 companies. We're marrying both fundamental and forensic and legal research to be able to help us to offer a what's inside view of the mutual funds. Most importantly, we at CFRA are independent. We don't manage money, we don't have an asset management arm, and we don't create products that are tied to our overall securities inside. You have a true understanding that when we have a 5-star rating on a mutual fund, it's because we are truly independent. Our mutual fund rating methodology combines, as mentioned earlier, both forensic and fundamental assessments of the underlying securities. This is a more forward-looking approach than others within the industry, as we are providing an assessment of the reward and risk characteristics at the holdings level and combining that with assessments of the cost of a fund, not just relying on past performance. Our rating methodology is updated on a monthly basis, and we're using machine learning techniques. Basically, our methodology gets smarter over time, adjusting to the risk and reward environment of today and not the one of the past. We truly believe that our fundamental analyst team of 75 equity and accounting analysts help us to offer a true assessment, second opinion of management's best ideas. But then we combine that with things that are more specific to the mutual fund. For example, the tenure of management plays a key role from a risk assessment of our assessment of the portfolio, because we believe that the manager's track record will walk out the door when the manager leaves. As you can see here on this slide, we have a breakdown of the cost, reward, and risk. We're using a 5-tiered star system, but we break down into 3 buckets. Cost, quite simply, is the expense ratio. But when we look at reward and risk, what we really want to do is look inside the portfolio, understand if there's high reward potential of the underlying holdings, and understand if there's risk mitigation that's taking place. What you'll see here on this screen are numbers giving you a sense of how high that overall score tends to be. A 90 shows that this fund is least expensive among its broader category, and a 62 for risk shows you that it's relatively safe compared to some of its peers. So don't get confused that when you see a high cost or a high score, that actually means it's more expensive. It's actually less expensive. We separately are rating mutual funds from ETFs, and you can learn more about our ETF rating methodology also on MarketScope Advisor. Lastly, when we are rating mutual funds, we break it down into 5 different categories. Within equities, we've got US equity and global equity. And within fixed income, you can see we break down credit-focused and government fixed income within the traditional taxable bond universe. And then we separately have a municipal fixed income approach. Each of these has a separate rating methodology and scoring system, because what is inside these portfolios and the driver of these portfolios will ultimately be different. Now I want to walk through a screenshot sample of one of our 5-star rated mutual funds so you can get a better understanding of how to read these reports and put them to use for you and your clients. We're using the American Funds Growth Fund of America, AGT-AJAX. This is a 5-star rated fund from CFRA. It happens to be lower rated from others within the industry, and there's easy to understand reasons why. We touched on earlier cost, reward, and risk. So let's go a little bit deeper. This fund has an expense ratio of just 63 basis points. That's much cheaper than its peers, which is what drives the overall score of 90, which is out of 100. From a reward perspective, we use multiple metrics, but specifically, you'll be familiar with the equity stars, the qualitative assessment from our team of analysts, where a 5-star is a strong buy, a 4-star is a buy recommendation, and so forth. When we look at the top 10 holdings, and we do an assessment of the entire portfolio, but the top 10 holdings, all of them are either buy or strong buy recommended, which helps to drive the reward score of 67. From a risk standpoint, we looked at the earnings quality using CFRA's proprietary earnings scores. And 6 of those top 10 holdings have scores that are favorable according to our quantitative research of the income statement and the balance sheet. We're further using other metrics. We touched on manager tenure earlier, and other metrics tied to the income statement and balance sheet, as well as short and intermediate term performance. So we are not relying solely on past performance the way that others are doing. We have a more holistic approach. We're going to move further down into the report so you can see the value add that our research is providing. On the lower half of the first page of the report, we will show a comparison of the fund that's on the report and some of its peers using Value Line's data. We've partnered with Value Line, which has, to us, a strong assessment of classifications as well as raw data that we can help to drive and power our overall rating. You can see here, this is showing other widely held mutual funds within the same peer group classification, a growth fund. And you can see how this fund, on the full report, how the fund is performing versus its peers and its cost structure. We're showing just on the screen the overall rating so that we can focus more on the American funds and not its peers. But you can see there are fellow 5-star rated funds from Fidelity and Vanguard that are listed here, as well as funds from T. Rowe Price and a second fund from Vanguard that are rated lower. One of the funds, which is Vanguard's Mid-Cap Index Fund, is part of the same peer group as American Funds Growth Fund of America. They both are in the growth peer group. We do not have a mid-cap peer group that we're using. Funds are in a variety of peer groups, including growth and income, growth, or a small company. So you can see we have a wider net that we're fishing in to be able to compare and contrast mutual funds than you may have seen beforehand. Let's move further into the report. On the second page, we have an assessment of the historical record. If you wanted to look in the rearview mirror, you would find out that American Funds Growth Fund of America is scoring relatively well from a performance standpoint, past performance standpoint, when we compare it to its Value Line peer group and the broader category. You can see how it breaks down on various quartiles, and it is in the top half of its peer group and the broader category, which is contributing favorably to our overall assessment of the fund. But we also think you need to look at the risk assessments of the portfolio. And so the lower half of this page has risk-adjusted metrics such as standard deviation and Sharpe ratio. Standard deviation, you want to find something lower than average to contribute favorably to your assessment of the risk-adjusted reward. That's the case here, 13.5 versus 14.3. Similarly, you want to find a Sharpe ratio that is above average, as we're seeing here. A Sharpe ratio of 0.82 is above the peer average of 0.55. We didn't focus on as much the beta and the R-squared, but we show this to be able to give an assessment and comparison, and that's using the S&P 500 as the overall comparison for all large cap equity mutual funds. Lastly, and to us most importantly, what's inside is driving the future results. So we talked earlier about CFRA's favorable assessment of the portfolio from a qualitative assessment known as our STARS methodology, again, 4 and 5 stars being most favorable, and an earnings quality score from CFRA that's more of a risk assessment. You can see all top 10 holdings, and again, this is just a subset of the portfolio, but all top 10 holdings are either buy or strong buy recommended. The strong buys, as you can see on the screen, include Alphabet, Broadcom, Charter Communications, and then similarly, some of these companies also get a earnings quality score of that's relatively low. You want to view this as the lower the number, the better. We at CFRA find that anything that is 7 and below has a favorable earnings quality score. And companies like Facebook, Microsoft, United Health Group are examples of companies that from a risk standpoint likely have understated earnings potential. That can mean that they can perform well, but also that they're not taking too much additional risk as they're assessing their income statement. You want to make sure that you don't have any red flags within the portfolio, and we only find a couple of those within the top 10 holdings. Most importantly, CFRA finds that going beyond past performance is extremely important. There is a reversion to the mean if you're only choosing mutual funds based solely on its past performance record. Lots of academic research supports that. Our research supports that. We think what's most important is understanding the risk and reward characteristics at the holdings level, understanding the cost, which can be a hurdle to have to overcome when you're trying to outperform. When we are rating funds, we are trying to identify what mutual funds have consistent records of outperformance in both up and down markets and have the likelihood or high likelihood of outperforming its category, either US or global equity, or in the case of fixed income, the 3 fixed income buckets that we have here. And to reiterate, we are using machine learning techniques. So our model is getting smarter over time. And every month we update our ratings, you will see changes as our model reflects the latest assessments of the mutual fund, CFRA's views of its holdings, and whether the model finds us to be more of a reward as opposed to a risk mitigation approach to it. And then lastly, we're differentiated from our peers, one, because we focus on funds that don't have a 3-year track record. That's more relevant in the ETF space, but separately, we're finding that if you compare a mutual fund with an ETF, you're comparing apples and oranges. What drives a mutual fund, often an actively managed mutual fund, is going to be quite different than an index-based ETF. And that's why we have 5-star rated mutual funds and 5-star rated ETFs, but those two universes do not overlap. Hopefully this gives you a good assessment of who CFRA is, our mutual fund rating methodology, and the various tools that are available for you. If you have questions about an individual mutual fund, please contact us at cservices@cfraresearch.com or the phone number that you see on the screen. Have a great day.